Hello everyone, my name is John and welcome to another episode on our PropertyLimBrothers Buyers series. So with all the cooling measures from December last year to the very recent announcements in September 2022, I'm going to be revisiting with you on this very popular topic, HDB loan versus bank loan when it comes to buying a HDB resale flat. So let's go. Before we start off this topic, to give you a little bit of context as to why this has been a recently hotly discussed debate. This is because the bank interest rates were trending at a very low 1 to 1.2% just last year. But now it seems that with the recent cooling measures implemented on 30th of September, many things have changed, including the rising interest rates as well as some of the loan technicalities. So compare this to the 2.6% interest rate of the HDB loan. Suddenly, it isn't an obvious or preferred choice to take on a bank loan when purchasing a HDB resale flat. Of course, interest rates have steadily climbed in line with the US interest rates hikes announcements. Now, in today's episode, we'll be looking at several key components such as eligibility, loan-to-value ratio, tenure, interest rates, sequence of disbursements, and their main differences between a HDB loan and a bank loan. So first up, the loan eligibility. In terms of the HDB loan eligibility, the borrowers need to fulfill several requirements. So these include a household of having at least one Singaporean, household income ceiling of not more than $14,000, haven't taken 2 or more housing loans from HDB before, as well as not owning any other properties locally or overseas. On the other hand, for application for a bank loan, usually as long as you haven't been defaulting on your loans or having a good credit score is sufficient enough to warrant a loan. Of course, in terms of how much you can borrow will depend on your income as well as the total debt servicing ratio, which is known as TDSR, and MSR, which is the mortgage servicing ratio restrictions framework that are put in place by the government to ensure that people do not borrow more than they can afford. Next, the loan-to-value ratio. So based on the cooling measure back in December last year, the amount of HDB loan-to-value was reduced from 90% to 85% and then a further 5% to 80% in the latest cooling measure in September this year. This is still a 5% more than the 75% LTV that you can get from a bank loan. So what this means for you is that as your loan-to-value ratio for HDB loan is at 80% with a large portion of the payment coming from the HDB loan, your initial cash outlay isn't going to be as high as a bank loan. Next, in terms of the maximum loan tenure, the maximum HDB loan tenure is 25 years. Conversely, instead of 25 years, you can take up to a maximum tenure of 30 years for a bank loan. So assuming if the loan amount is similar, it can mean a lower mortgage payment per month as you are given more time to finance and pay off your housing loan. Moving on, let's look at the interest rate differences between a HDB loan versus a bank loan. So for the interest rate for HDB loan, it is pegged to the current CPF OA interest rates plus 0.1%. Hence, as current CPF interest rate is 2.5%, it makes the current interest rates for a HDB loan to be at 2.6%. This interest rate has also largely remained stable vis-a-vis the more variable interest rates from the bank. Now, bank interest rates have largely hovered in the 1.5% range last year. At the first half of this year, it has shifted upwards to the range of 2+%, and recent hikes have brought the rates to be around 3.5%. So depending on the market conditions, bank loan rates are usually more variable. This also applies to the loan packages that are pegged to fixed interest rates as well. So after a lock-in period of 2 to 5 years, these so-called fixed rate home loans follow a floating rate. Now, I'm not going to bore you with the technicalities of SIBOR or SORA or the bank spread. If you're looking for professional and easy help to finance your next home, we found that PropertyGuru Finance has comprehensive tools to help you get the best mortgage rates across all major banks. You can get objective, unbiased advice from PropertyGuru Finance mortgage experts and save more in the long run.
PropertyGuru now offers home financing services. If you are unsure which bank to go with for your loan or urgently need to place an option to purchase, turn to PropertyGuru Finance to compare loans and get an in-principle approval. Get honest, unbiased advice from experienced mortgage experts who will handle all the paperwork, making your home loan application hassle-free. Once you have taken your loan, use SmartRefi to monitor it. SmartRefi will track your loan and tell you the right time to refinance, giving you extended peace of mind. And all of this is absolutely free. Save money on your mortgage with PropertyGuru Finance today.
Next up will be the actual amount of loan and sequence of disbursement of loan. Now, many people have the misconception that they will be loaning 80% of the valuation. Actually, this isn't the case for most of the time. There is a particular sequence of disbursement which ultimately will then derive the amount of HDB loan that you will be undertaking. So number one, starting from the very top when you put in the down payment comprising of the option fee as well as the excise fee. These two components are purely from the cash component for a resale flat. These are typically in the $1,000 plus $4,000 arrangement. After you have exercised the option for the purchase of the resale flat, it is mandatory for you to wipe out your CPF in the ordinary account. But CPF is also very kind as you are given the choice to keep up to $20,000 per buyer in your OA should you wish to. Only after all this, then the remaining balance amount will be covered by the HDB loan. Let me share with you a simple scenario with you to better illustrate this point. So taking a married couple for example, Michael and Georgina, and they wish to purchase a resale 5-room flat which costs $750,000. So for simplicity's sake, we assume that valuation matches. Now both of them have a combined amount of $200,000 in their CPF. They then make the decision to keep the maximum of $20,000 each in their CPF OA, hence utilizing $160,000 from their CPF. In terms of the right sequencing, after lessing off the $5,000 down payment and the $160,000 from CPF, the remaining $585,000, which is 78% of the price, will then be the amount that falls under the HDB loan. Notice this is lesser than the 80% as mentioned. And of course, if there are eligible grants for the couple, this further reduces the amount of HDB loan that they need to take. So in terms of the bank loan, if you choose to take the full 75% loan, you'll be granted the full 75% amount assuming your loan affordability is all good. Lessing off the 5% down payment in cash, you will then have a choice of how much CPF or cash you wish to portion in terms of payment for the 20% balance. Some of you may choose to use more cash if you deem the 2.5% interest rate, which you can earn through CPF, to be attractive. This also means more current available funds in CPF for your monthly mortgage payments moving forward. Alternatively, if you choose to use more CPF funds, this can then free up more cash for your other investments. Next, early repayments differences. For HDB loan, if you suddenly have a large amount of funds and you wish to pay off the mortgage loan, you can pay off however much you want without penalty. But for a bank loan, there is usually a penalty fee if you decide to make early repayments or do a refinancing within the lock-in period. Some other things to take note is that there is no minimum loan size for a HDB loan, whereas for a bank loan, you will need to loan typically a minimum of $100,000. In terms of late repayment penalty, the HDB loan is charging a late fee at 7.5% per annum, which is more lenient as compared to that of a bank loan. Hence, in conclusion, although it may seem like a good thing that you can borrow more funds from a HDB loan, getting a bigger loan over a longer tenure could mean you end up paying more interest in total. Borrowing a lot lesser from a bank loan could also mean more savings in the long run. For now, it does seem to look a lot better taking a HDB loan due to the high interest rates that the banks are getting. Especially if you are conservative and want to splash out less cash outlay, have less uncertainties and perhaps be more hassle-free, then take the HDB loan. But do note that your CPF will be heavily utilized. Another perspective that we can offer for you is to take on the HDB loan for now, and when the bank's interest rates start to look more attractive than the HDB rates several years later, what you can do is then to do a refinancing to a bank loan. Do note, however, that this route is a one-way street and you cannot opt back into HDB loan thereafter. All in all, there's no right or wrong as everyone's financial plans and life situations are different. Speak with a professional should you require assistance. So we have come to the end of today's episode and we hope that this has been helpful. Click on the like button if you have enjoyed our content so far. Till the next one, I'm John from PropertyLimBrothers. Cheers and take care. Welcome to another episode on our PropertyLimBrothers. Sorry. All that. Let me just check this. Sorry. Another episode on our PropertyLimBrothers.